Well, the stock market spent much of the day spinning its wheels as investors continue to grapple with the message from this morning's jobs report. Now, that said, you got two sides, right? The political observers said it was a solid report, but, the report might have a muted impact on the election, but there were a couple of things. Higher-end jobs did well, but manufacturing and mining, they continue to struggle. That's reflected on the electoral map. Two wild cards that we should point out. Construction surge, big job jump there. Also, higher wages, which are now improving well above the rate of inflation. That's something to keep in mind. On the stock front, however, there was a different sort of observation. A lot of people calling this Goldilocks. And nevertheless, the number, while it missed the consensus estimate, probably enough to keep that December rate hike on the table. And I think the street is grudgingly coming to accept that. Meanwhile, the market continues to look for leadership. Tech stocks, they've been doing great. I mean, semiconductors have led the way, cloud computing stocks have led the way, but let's face it, they've got limited coattails. Finding value in this market is very difficult at this point, and that means buying stocks that are down and hoping that bad news is better than it could have been is the way to work. In case in point, the stock of the day was Gap Stores. Now, the company posted better than expected numbers, but it was not the stuff of legends. Stock had a great day. Overall, a tight trading range continues to keep money on the sidelines, so watch key parameters for whether or not you want to become more aggressive or maybe even raise cash. For the Dow on the upside, a close above 18,560. That's when you really start to get aggressive. If we go below 18,000, you may want to raise cash. That's my thoughts. I want to discuss it now with Dan Celia, who joins us. All right, Dan, what are your thoughts here? The market, the economy, the market spinning its wheels?
Well, Charles, the job numbers, according to Stanley Fischer, was very close to being ideal. And I think one of the things that we have to take into consideration through all the numbers that we saw today is the bar for all the economic data has been lowered to an incredibly low level. I mean, no one seems to want to talk about 2% growth, GDP growth for the last 7 years. So we have to keep it in perspective. I thought one of the best signs, one of the good things that I saw out of these numbers was the unemployment rate going up to 5%, meaning a few more people coming back in to labor participation. Obviously, we need to see that in order to see a real recovering economy. Right. So we're still in 1978. But nonetheless, it did go up, and I think that's a good sign.
Well, millions of people dropped out in the last year. 3 million people have come back. The frustrating part, though, is that they're having a tough time finding those jobs. So to your point, we want to see people hit the bricks because that makes it work. But they also need to be able to get these jobs. And apparently they say 6 million jobs are out there to be had. Before I let you go, though, Dan, your thoughts on the market. There's no more big economic indicators. So what moves this market over the next couple of weeks?
Well, I think what's going to move it is uncertainty and fear about the elections, and it's probably not going to move it in the right direction. So I think we're going to continue to see some concern. We're entering the heart of earnings season, and we could be staring at the 6th straight quarter with negative earnings reports, and more than that, revenues. We've got to look at profitability in the earnings reports and same-store sales in the retail sector and those kinds of things.
Well, again, because the bar has been set so low, a company like the Gap can have normally what will be perceived as an ugly number be accepted as a great number. Those low expectations, to your point, stock takes off. Hey, Dan, have a great weekend, buddy.